PR Connections Radio presents.
Okay, welcome to the Real Deal Podcast. I'm your host, Davin Sundvik, and on this show, we're primarily going to be talking about real estate, business, and financial strategy. The ultimate goal is to get you wealthy and actually understand what is real and what is legit out there. So, going over something interesting today, I want to talk about the state of the real estate market. Just so we have a starting point for this podcast. So currently we're moving the needle into a buyer's market, which is a really interesting phrase. A lot of people think a buyer's market means housing prices are going down. Doesn't necessarily mean that. But what it does mean is there are more opportunities for good deals, and it can actually slow the amount of appreciation that we have, which essentially just means there's a little bit less competition out there for a short-term period of time. So what we're going to be going over is how to navigate a buyer's market. Make sure you end up on the winning side. Next podcast, we're going to be going over how to position a business for sale. And then the podcast after that, we'll go into how to prepare for a recession. Because in my opinion, if you're not prepared for a recession, you're not going to buy a house. If you're not going to buy a house, you're not prepared to avoid inflation, which is always more likely than a recession. So let's first go over kind of the basic problems most home buyers face when they are trying to buy a home in a buyer's market. The first one is the monthly payment trap. They focus only on one element of buying a property. Instead of the bigger picture. In case you don't know, there are actually 5 ways that people make money in real estate. And if all you're doing is comparing your current rent payment to your future mortgage payment, you're missing out on a wide variety of not only other costs of owning a home, but also the other profitability potential areas of owning a home as well. And knowing your current financial position and working with an expert who's worked with a lot of people and seen a lot of successes and failures can help you avoid those homes that are really out of your price range that may not look like they're out of your price range, but then also help you navigate toward a way where you're going to build some wealth as well. So that's the first the first mistake is the monthly payment trap. We'll go over some of the solutions and what we found along the way later on. Next one is opportunity cost. Misallocating money can have a compounding consequence on how much wealth you can build. A lot of people believe that they have to put a really large down payment down in order to get a good deal on a house. That's just simply not true. We'll get into debunking that myth later on in the podcast. The next issue most buyers are going to worry about is dream home waiting. They're going to create this criteria, this perfect house that's going to fulfill everything that they need to ever have in their life. And they're 25 years old, just starting out their career. And whether you're 25, 30, 35, it really doesn't matter. Your first home is most likely not going to be your last home. So waiting for your dream home to hit the market is going to be a huge missed opportunity. It's way better just to buy a home that works for your current needs now, wait for that home to go up in value, and then purchase another home later. And we'll actually go over some more details on how you can hack that system to have even more success. The next mistake that I don't want to say most home buyers, but a significant amount of home buyers are going to do is they are not going to be prepared for recessions. Now, you should absolutely be prepared for a recession, but what you shouldn't do is you shouldn't be waiting for the real estate market to go down in value, which kind of gets into our 5th mistake here, which is worrying about real estate crashes, right? So you definitely want to be prepared for a recession, but we don't want to be so prepared that we're actually trying to wait for a recession in order to buy a house. For a wide variety of reasons, real estate crashes are typically not that often, and it's way more likely that hyperinflation will destroy your budget and your retirement goals. Way more likely that that's going to happen than a recession happening and ruining your retirement goals. That only happens maybe 5 to 10% of the time. And if you can muscle out the storm, you can make it. So those are some of the main problems that most buyers will be dealing with in a buyer's market. Unlike a seller's market, when you have a lot of buying competition, you have to move at a really fast pace. In a buyer's market, some of the benefits are is you won't have to move as quite as fast of a pace. The housing market is not going to appreciate, and the home that you're shopping for isn't going to appreciate out of your price range in a short period of time. So you're not really in a rush to buy in a buyer's market. In a buyer's market also, sellers can be more motivated, which means that if you're willing to be reasonable, but you're trying to negotiate, you might be able to get some more favorable terms. And if you don't know, price is actually not the most important factor when purchasing real estate. The terms are the most important part. If you can get good terms, then you can negotiate a lot better deal for yourself by negotiating against the bank instead of just negotiating against the seller. Obviously, I want the seller to give me as good of a price as I can, but once we max that out, I want to also negotiate against the bank. Having good terms helps you do that. All right. So let's go over some of our findings and solutions. A lot of these findings have just been from my experience working with really successful home buyers and watching what they do in order to succeed. But also, I've run the numbers and some mathematics, and we'll go over just some basic overview on the numbers so you actually know that there's some data back behind some of these suggestions. So the monthly payment trap. Like we said, there are 5 ways to make money in real estate. The first one is passive income. This is what I call rent replacement, right? This is the amount of money that you would have been paying in rent, but now you're paying yourself and you're paying the bank a mortgage instead. And when you pay off that mortgage, you still get the benefit of not paying rent to a landlord. And as rents rise, the benefits of you owning and having that fixed monthly payment instead of a, compounding, increasing monthly payment is definitely better as a homeowner than as a renter. So that's what we call the passive income portion of real estate ownership. The next one is price appreciation. Now, most homeowners don't directly benefit from the price appreciating on their property. However, think of it this way: the more the house appreciates in value, the more you could rent it out to someone else for if you were to leave that property. So in theory, yes, appreciation and passive income are both tied together, even though they don't always move. They're not dependent on each other, but they are related to each other. So they are somewhat independent variables when profiting off a real estate deal. The third way that people make money in real estate was I call massive income. Sometimes certain events happen and they create opportunity. Now, not every single person has access to massive income in their market with their particular property, right? Sometimes you just find a niche that works well and you can create more income than what you would have been able to create by just simply passively renting out the home. I'll give you an example. In my particular neighborhood, it's not legal to run an Airbnb based on the location of other Airbnb licenses. But there are other counties that do not have such strict standards as Clark County does, and I could purchase a home there, rent it out as a short-term rental, and make much more cash flow than I could as a long-term rental. So that's just an example of massive income using real estate. Tax benefits are the fourth way that real estate investors benefit from owning real estate. Now, there are 2 different tax programs for real estate owners. There's the home owner tax program, where if you live in a home, $250,000 worth of capital gains is tax-free. And then if you're married, $500,000 worth of capital gains is tax-free. If you're an investor, you have access to depreciation and 1031 exchanges, which allows you to roll the capital gains into the next property that you're purchasing. And when you pass away, your children get a step up in basis and they can sell that property without paying capital gains tax unless it then continues to go up in value after they continue to hold it after you're passing. So quite a few different ways to benefit in taxation from owning real estate. And don't think that that's not priced into the market. Whenever there's a benefit or a tax benefit or a way to avoid paying taxes with any asset class, it instantly bumps that asset class up a little bit more in value than with some of the what I would call tangible benefits of real estate. And that goes back to that passive income portion. If you're only looking at the monthly payment and somebody else is looking at the monthly payment and the tax benefits, they're going to win because they understand some of the nuances and some of the other benefits that they're going to be getting from owning that piece of real estate. And you're not looking at those benefits. So then therefore, you're not willing to compete with them when they're offering a little bit more than you. So that's something to consider. The fifth way that we make money in real estate is what we call leverage. Leverage is the ability to essentially have more buying power than what you would have with cash. And so how I like to think about it is if I could buy a $300,000 home with $30,000 worth of cash, and I'm hoping that one day that property is going to double in value to $600,000, I have access to $300,000 worth of capital moving in an upward direction. Versus if I were to take that $30,000 and put it into the stock market and hope it would double, yes, it's still doubling, but that only turns 30,000 into 60,000. I'd much rather turn 30,000 into 330,000. So that's a good example of how leverage can make you more money in real estate than by just paying cash. So if you're out there and you're a buyer, our solution, our recommendation, work with a knowledgeable agent who can see the bigger picture, not just somebody who opens doors and puts out some ads. Really try to find somebody who can interact with your financial advisor, your financial goals, and write the contract that works best for you. Okay, next thing we're going to go over is opportunity cost. Our findings in our office is typically that home buyers who pay 5% or less on their down payment actually save the most money. Now, you might be saying, well, if you put 20% down, your monthly payment's going to be lower. And remember, we're going it back again to that monthly payment trap. Yes, the monthly payment will be slightly lower if you put down 20% compared to 5%. However, if you were to take that difference and you were to invest it into, let's just say, your Roth IRA, and your financial advisors getting you about a 10% return per year, that would lead a portfolio difference to about $260,000 difference by the time you're at retirement age. So obviously it depends on how much you're putting away per year. I just made the assumption that you're putting in roughly $10,000 a year into some account that a financial advisor is managing, and again, getting about a 10% return. So if your cost of capital is more than 10%, meaning you think that you can get better than a 10% return, then this gap would increase exponentially. And this is also assuming a 7% interest rate, which means in a low interest rate environment, you would actually spread that gap even more. So very critical for our young home buyers to understand opportunity cost and help them work through that with their financial advisor to pick out what's going to work best for them. The next thing is real estate crashes. Okay, so our findings is that 99% of the time in a year-over-year period, so within a 12-month period of time, the real estate market is going to go up. There's only been a couple of times over the past 100 years where the real estate market has been down for more than 1 year. And it doesn't happen very often. Most real estate corrections are less than a few months. And so usually that just means over the winter months, in certain areas, real estate prices go down, but then they pop right back up in the summertime. So that's something to consider about. So the most volatility that we've had in the real estate market has happened over the last 20 years. And we have averaged less inflation in the last 20 years than in the past 100 years. So what does that mean? Well, if inflation is going like this and then it flatlines for a little while, which is what we've experienced over the last 20 to 25 years. It really means that we're kind of due for a spike in inflation. We saw, in my opinion, a hint of that in 2020, 2021, and 2022. But I really do think that's just a taste for what is coming over the next decade. I really hope that home prices don't go astronomically higher. I hope that my grocery bill doesn't get astronomically more expensive. But here's the thing. I own real estate because it is a hedge against inflation. So waiting for real estate crashes is typically not a good purchasing strategy. Purchase when you can, what you can afford. All right. Waiting for dream homes. We talked a little bit about the strategy of, hey, just buy something that you can afford that fits your budget and what you need now. But one comment that I get is, hey, if your dream home is worth $800,000 and you buy a $400,000 house, both houses double over a certain period of time. Let's call it 15 years, right? Now your purchasing power is 800,000 because that's what the value of your home is. But your dream home is still $1.6 million. It's actually getting further away from you being able to purchase it than when you first purchased your initial, what we would call a starter home. And this is a strategy that my wife and I had considered. I have a goal of owning some land one day. I want to maybe own a little bit of a hobby farm, or maybe even a bigger farm, whatever I can afford. And my wife and I strategy is to live in our first home and purchase some rental properties. And so, for example, if you own a $400,000 home, you purchase a $400,000 rental property, and your dream home is $800,000, you don't have to deal with the burden of the monthly payment it would take to purchase an $800,000 home. What you can do is allow the real estate market to go up or go down. It really doesn't matter because your purchasing power is going to stay the same. And as a matter of fact, as you pay down those loans, the cost for you to acquire your dream home by consolidating both properties. And what I mean by consolidating, I just mean selling two $400,000 properties and purchasing your $800,000 property. That would be consolidating. The cost to consolidate goes down as you pay down the loans on both of those properties. And since you're living in one and a tenant is renting out the other, the tenant is really paying for the vast majority of the cost of consolidating. So something to consider if you do have a dream home, you have a very specific plan in life, and you want to be protected from inflation. Owning a couple of rental properties can be a really good strategy. My findings, though, is some of the benefits from owning rental properties, unless you're going to be in the business of being a landlord long term, the benefits typically tend to fall off around 3 to 4 rental properties. So consider that in your retirement plan. Being real estate heavy is a great strategy, but I never would recommend that every single person invest everything into real estate, because unless you really want to be a landlord for a long period of time, it may not be worth it for you. Next thing we're going to talk about is preparing for recessions. It actually seems like it's going to be the last thing on my list that I'm going to talk about today. Preparing for recessions is something to consider because a home is not a liquid asset. And what I mean by that is it's subject to somebody else's feelings, right? They purchase it based on what they feel the house is worth. And your home's value can fluctuate wildly depending on, not only the state of the market, but the condition that it's in. You might be willing to overlook a crack here or a hole in the wall there, or we got a leaky faucet here that we'll fix next year. I mean, a lot of these little things really do tend to add up. And unless you're really on top of your home maintenance, most likely you have something wrong with your house. I very rarely inspect a house that we're going to put onto the market that doesn't have some underlying issues, unless the homeowner specifically went through it with a fine-tooth comb to put it on the market. So something to consider is your home is a fairly illiquid asset. However, like we talked about earlier, it's going up in value just with the natural state of the market fairly rapidly. The maximum value that you could get for your home, if it was in good condition, is always rising 99% of the time. So with that being said, I typically recommend that people have 6 months worth of cash that's just sitting aside. Yes, it's getting pelted by inflation. Yes, it's not working in the market. Yeah, I get it. But when you have an incredibly important asset like a real estate asset, this is where you house your family. This is where you're going to put some of your retirement planning based on the fact that you'll be paying off your home at some point in time in your life. You do not want to lose that asset at the bottom of the market if something were to happen. And so having 6 months worth of expenses is going to help you brace that storm in order to get through any financial crisis. So for example, if you lose your job and you're not making quite as much as you would want to, or as much as you could have, having 6 months of expenses can actually stretch way further if you're supplementing that income. I just had a client the other day. They had an issue, with their budget. They called me up to potentially sell their home, and I looked at their budget and I said, "Hey, we're about to make a $5,000 decision here, and you only have a $2,400 deficit in your budget over the course of a year." They were planning on moving in a year anyway. So instead of selling their home now for less than what it could possibly get, they're going to spend the next year fixing up their home and making it even better, making it even more likely to sell for absolute top dollar. Also, remember what I said at the beginning of this video. We're in a buyer's market right now. And if that buyer's market triggers demand, and then all of a sudden buyers enter the market, that's going to eventually, not immediately, but eventually lift the prices of homes. So my client will most likely sell their home for more in a year from now versus selling it for today. And like I said, they're planning on moving in a year. So if they were to sell their home right now, they would still have to find a place for rent. So we're talking about lost wages from moving. We're talking about all the expenses of moving, putting down a security deposit on a landlord who you don't have the plan of being in a long-term relationship with, meaning who knows if they're going to be reasonable on giving you that security deposit back. And you can't control the property the same way, because if your dog decides to damage that property, you are on the hook for the damage that is done. Same thing as owning a home, but you're essentially doubling your liability. You have your home, which needs to be repaired, and then now you have this property you're renting from somebody else that needs to be repaired. So sometimes just having a little bit of extra cash on hand can help you prevent from being in desperate situations. And just kind of a good story. That client was able to take my advice. They gave me some feedback that they're going to wait to sell their home for another year, and they will most likely be in a better financial position for it. So if you have any questions about the real estate market, whether you're thinking about selling your home in this current buyer's market, you need somebody who can help you navigate that and still get top dollar even in a buyer's market. That's where you call Sundvik Realty. You can call me at 702-518-1606, or you can go to my website, ethicsrealtylv.net or ethicsrealty.net. I think ethicsrealtylv@gmail.com is my Gmail. We just did a rebranding, so please give me a little bit of grace as I'm getting used to some of even my new branding as well. I do appreciate you guys for watching. Again, this was the Real Deal podcast going over how to navigate a buyer's market.
Get $50,000 plus in funding without using your social security number and without putting up collateral. It's simple, it's easy, and best of all, it won't affect your personal credit. Just use promo code PRTalk when you reach out. Click the link in the captions now. Or call 702-210-4201 to speak with an expert. Funding made simple. Let's get you started today.
PR Connections Radio thanks you for watching this podcast. Check out more episodes of this show and our others at prconnectionsradio.com.